All right, today we're going to open up the Investor's Toolkit and really look at some of the strategies you can use to master your portfolio. Now, think of this less like a set of rigid rules and more like a collection of really powerful tools that you can use to build a stronger, more resilient investment strategy. So let's dive in.
It's a weird question, isn't it? A paradox. But really think about it for a second. You have one investment that just takes off. It does exceptionally well. Well, that means it can grow to become a much, much bigger piece of your portfolio pie than you ever planned for. And yeah, that success feels great. But it can also secretly concentrate your risk and quietly throw your entire long-term strategy way off balance. This whole phenomenon actually has a name. It's called portfolio drift. It's what happens when the natural churn of the market, all the ups and downs, causes your carefully planned asset allocation to just drift away from its targets. So that portfolio you designed to be a nice, stable 60% stocks and 40% bonds, well, after a hot year in the market, it could easily drift to 70% stocks, which is a lot riskier than you signed up for. So what do we do about this? How do we fight portfolio drift? Well, the very first and most fundamental tool in our kit is the discipline of rebalancing. And I use the word discipline for a reason. This isn't about trying to time the market or chase the next hot stock. Nope. It's about systematically and unemotionally bringing your portfolio back in line with your original goals.
At its heart, rebalancing is actually pretty simple. It's just the process of nudging your investments back to their target weights. You can think of it like hitting a reset button, taking your portfolio back to the strategic mix you decided on when you were thinking clearly and calmly, not, in the middle of a crazy market rally or a scary downturn. And here's what's so powerful about this. Rebalancing basically forces you to follow the number one rule of investing: buy low and sell high. I mean, think about it. You are automatically trimming the positions that have done really well, that's selling high, and you're using that cash to beef up the ones that have underperformed, that's buying low. It's like built-in automated discipline. So how do you actually get this done? Well, there are two main ways to go about it. The first is time-based. Here, the calendar is your trigger. You just pick a schedule, say once a year or once a quarter, and you check in and rebalance. Simple. The other way is threshold-based. With this one, the market is your trigger. You only step in and act when one of your asset classes drifts past a certain point, like maybe 5% away from its target.
Let's make this super concrete with a quick example. Okay, let's say your target is 60% stocks, 40% bonds. But the stock market has a fantastic year, and it pushes your stock allocation up to 65%. Uh-oh, you've drifted. So to rebalance, you would take action. Sell off that extra 5% of your stocks, locking in those profits. Then you just take that money and buy more bonds. And boom, just like that, you're right back to your 60-40 target and your risk level is back where you want it to be.
Now, in today's world, you don't always have to sit there and do this manually. A lot of robo-advisors and brokerage platforms offer automated rebalancing, which can be a serious upgrade to your toolkit. But is it always the right move? Let's talk about it. The argument for automation is, well, it's pretty strong. First off, it completely takes emotion out of the picture and enforces that discipline perfectly, every single time. It's also super convenient, totally hands-off. And some of these systems are even smart enough to look for opportunities to sell positions at a loss to help you lower your tax bill. That's a cool strategy called tax loss harvesting. But there's no such thing as a free lunch. You've got to consider the costs. Are there trading fees every time the system makes a move? And if you have a taxable account, more frequent trading can mean a bigger tax bill from all those gains. So the really crucial thing here is to understand exactly how your platform does it. The way one service automates rebalancing might be totally different from another, so you have to make sure its strategy actually makes sense for your goals. Okay, so we've covered how to keep your portfolio on track using rebalancing. Now let's shift gears and talk about what your portfolio is actually made of. And this brings us to one of the really big debates in investing. Should you be focusing on broad market ETFs, or should you be picking individual stocks? Let's just break it down. With ETFs, you get instant diversification, usually for a very low cost. You buy one share, and bam, you own a tiny piece of hundreds or even thousands of companies. This just crushes the risk of any one single company blowing up and taking your portfolio with it. On the other side, picking individual stocks gives you direct control and the potential to outperform the market. But it also concentrates your risk, and let's be honest, it often comes with higher costs and a much bigger time commitment. But here's the thing, and this is maybe the biggest takeaway. You might not have to choose. I know these two approaches seem like they're from different planets,
But for a lot of investors, this is not an either-or decision. In fact, one of the most effective strategies out there actually combines the strengths of both. And it's known as the core satellite approach. It's a pretty cool idea. You build the stable foundation, the core, of your portfolio with those low-cost, super diversified ETFs. Then you use a smaller chunk of your money to invest in individual stocks, your satellites, where you have a strong belief in a company or want to target a specific opportunity. You really get the best of both worlds, stability and the potential for a little extra kick. So, at the end of the day, all of these things we've talked about, rebalancing, automation, ETFs, individual stocks, they're just components. They're just tools. The real goal is to use them to assemble an investing blueprint that is uniquely yours, because there's absolutely no single best strategy that works for everybody. So, what does your personal blueprint depend on? Well, you have to ask yourself some honest questions. How much skill and knowledge do you really have? How much time are you willing to commit to this? How much risk can you actually stomach without panicking? And, maybe most important of all, what are your long-term financial goals? The answers to those questions will point you toward the right mix of strategies for you.
So, the tools are on the table. You get the discipline of rebalancing now. You understand the pros and cons of automation and the different philosophies behind ETFs and individual stocks. The only question left is the one you see right here. Now that you have the toolkit, what kind of investor are you going to build?